Eric Muathe at Muathe.com. In this video, we're going to take a look at the RSI in relation to two levels. So the first level we're going to take a look at is the 61.8 level. And this again is based on the RSI. Now, I'm not 100% sure, but I believe I haven't seen anybody talk about this concept. So I might just be the first one to pioneer this idea as far as looking at the charts in relation to this level, and the other level is 38.2. What we're going to be taking a look at is only periods where we have uniform activity of any kind, any type of uniform activity and rejection at around the 61.8 level. That tends to be a sell signal for a swing trade lower. And on the other hand, anytime you have any type of uniform activity, it could be a double bottom or a triple bottom. It could be something like that, or even a dome type formation. So any type of uniform activity around the 38.2 level tends to be good for a buy for a swing trade. So let's take a look at the chart example. And here we have AMAT, applied materials, and we're going to be taking a look at all the data on the monthly going back about 33 years. So there's a lot of data here, but it's a good example because it's going to give us a good lesson into this theory. So first thing to do is we're going to draw a line here, somewhere around there, around the 61.8 level. And remember, we are only looking at the periods where we have uniform activity rejection at the 61.8 level. So the first example we see here is in the mid 1980s. So here, and here, which gave us the highs there, and there. But we can see that based on this chart, right? So we might have to zoom in. So let's do that. I'm going to zoom in the next chart. And here we have data going back from 1984 to about 1993. And we're going to draw the line again. So at about the 61.8 level, which is right there. Now this is uniform action. It might not seem like that, but this is uniform action above the line, back below it, and again uniform action. It's not the best, but it is close enough. Uniform action above the line and back below it. And one way you can actually confirm this for yourself is to simply draw a line in between at the middle point. So like here, that seems like that's uniform activity on each side, and even here looks like this is uniform activity. In other words, it is. So let me expound on that a little bit. So what we are doing here is sometimes you got to be a little bit on the creative side. So what we're looking at here is something like this. This is what happened. And I'm saying if you take a line and draw a line at the midpoint, you see that both sides are uniform activity. This side is equal to this side. That's uniform activity. And then it comes back to test the line, holds. So it's a reset, and then goes again above above the 61.8 threshold and back below it. So we can actually draw a line right there, and again we see that it splits it in half. This side is equal in time and space to this time here, and also the volume is the same. So that is uniform activity. So by the time we drop back below the line here, that is uniform activity. So with this line here, which means it's a short-term sell signal, that was good enough for a movement lower, as we can see here, which also corresponds with the crash of 1987, coincidentally. At the same time, we can see that we go above the line and back below it with uniform action at the highs of 1988, and again we get another swing trade lower. And then we have another situation where we go below the line and back below it, which is this level here, for the highs of 1990 before we get this swing trade lower. Remember, we are only looking at the perfect example so we can reinforce this idea. We're going to skip all the other areas. So back to the main chart, and again back to the all data for AMAT, applied materials. I'm going to draw the line again, the 61.8 threshold. So 61.8, and here we can see again uniform activity in 2007 above the line, back below it for those highs, and again here uniform activity rejection for the highs of 2011. Both of them gave us swing trades to the downside. So we can see that that pretty much is consistent with our expectation that when we get uniform activity rejection at the 61.8 level, we tend to have a swing trade to the downside. Now let's take a look at the other threshold, which is the 38.2. And I'm just going to draw a line right there. Remember, we are looking for uniform activity support, which would mean an entry for a swing trade to the upside. So at the 38.2, and to begin with, we can see here there's a low, there's a good support here in 86 and here in late 1990, but we can see that in terms of price. What we're going to do is zoom in back to the previous chart in the mid 80s to early 90s. So we are going to draw our line right here at the 38, around the 38.2 level. So 38.2, and this is the monthly chart. You can see a band of support here which gave us those lows, and after that we get a swing trade higher, and then there's another support here which also gave us the lows here on a monthly basis, and we get a swing trade after that. Now if we go back to our long-term monthly chart, bring back the 38.2 level again, 38.2. now remember, this is approximate 38.2, and we can see, so of course these were lows that were actionable in terms of a swing trade, lows there which were good entries, and again there was a low here in 96, which is that entry, uniform activity support, which is that entry there, 98, and all these other bounces on the 38.2 level led to a swing trade to the upside here also, and again here double bottom support for those lows, and then we can see support here of those lows, support here of that low level, and then the next uniform activity is here, which is that entry, a band of support here, double bottom support, which is off those lows, and again recently we can even say off the lows of late 2015, that was based on support at the 38.2 level. So there you have it. It's a good example of how we can use the two levels we talked about, 61.8 and 38.2, to give us turnaround situations. Now before I conclude here, I want to bring back the 61.8 level. So let me draw that again. And not to confuse anybody, we can see we draw the 61.8 level here. We see that there's also another way of looking at the same levels. Here's a good example. It can, even though we are looking at sell signals when we have uniform activity, so all these uniform activity levels here were sell signals based on uniformity rejection at the 61.8 level. You can actually even use the same 61.8 level or even the 38.2 depending on the situation for support. In other words, the exact opposite. A good example is here. This is in 95 And I'll zoom into that time frame to show you that you can also use this for a buy signal whenever you see uniform activity support at the 61.8 level. So let's zoom into that time frame, and here we can see what I'm talking about a little bit clearer, which is this level here. So we're talking about this bounce. We went below 61.8 and back above it with uniform action, which gave us this entry here at the beginning of 1995, and which led to a major swing trade to the upside. So you can use it for reversals where you have uniform activity rejection, and also we can see here the theory also means that if we have uniform activity support, that can also be used as an entry level. Here is a good example. And not to confuse, you can see here double bottom support in 92 before the lows here and before a major move to the upside. Eric Muathe, Muathe.com. As always, good luck, peace, and blessings. ERCS.